A lot of people are trying to get their house in order to prepare themselves for what the economy and the industry is going to bring over the next sort of 2 years. It's interesting though, we're not seeing what we typically see when we head into that period, which is a downturn in spend. We're actually seeing the opposite. Again, trying to prepare themselves. Informing that outlook is that we're seeing a significant movement of clients moving money from strong acquisition-driven activity and media, therefore benefiting, to brand and driving preference. So, and it is very significant, I'd say, in the clients that we look at. Again, trying to drive brand preference and preparing themselves for a tough economy where they don't want to be judged purely on or differentiated purely on cost, again, is an indicator that we need to start battening down the hatches a little bit. So the turnover of clients and marketeers seems to be really, really significant at the moment. And from a MarTech point of view, and that's both at our business and at my alma mater to the left here, but what that's doing, in my observation, is stopping and starting and stopping and starting a lot of bigger MarTech initiatives. So, you know, 1 minute we're seeing clients investing significantly in, call it D&P technology and a whole raft of other things. The next minute it's on hold and we're thinking, is this right for the new strategy? And it seems quite common that. And whether that's the case in the US or UK, I don't know, but it's certainly something we're feeling is slowing us down a little bit here. Never quite getting off the starting blocks in clients' organisations, and therefore not getting the learnings and the real momentum behind that in the industry.
Yeah, I think the marketers feel battered. You know, they're being squeezed in number, they've got a turf war with the CIO and the CTO, you've got a tenure that's on average, 18 months? Oh, and who would do that job? Oh,
Are you addressing the audience?
Tough. I think it's really tough, but it's a time for CMOs to make sure they have incredibly good trusted advisors around them. I'm not talking about me, although I am one, but I'm talking about generally your suite of trusted advisors.
I can see that pocket full of business cards
is very
#MeganJustSaying.com.
No, it's your agencies and all of your advisors are more critical than ever before because the world's more complex.
We've got this tension between MarTech and clients wanting kind of increased tech solutions and then the tension of procurement. And so what we're seeing is a real kind of rise of procurement in the market. It feels like a lot more pitches, but then every year feels like a lot more pitches. And that tension, I think it's a really good point around the fact that a consistency of agency relationship, whether that's a consultancy relationship or an agency relationship, breeds longer term solutions. And I do find that those longer term solutions are really what clients are actually wanting, but then procurement are driving them on price and other kind of more rational areas.
Investors try and predict where the flow of money is going to be on a 2+ year basis, and then they'll try and invest ahead of that trend. So unfortunately, as the investor base, the tools that we have to identify these trends versus industry insiders is fairly limited. We're relying on things such as GfK, OzTam for audience data. We're relying on SMI and CISA for ad expenditure data.
Underlying assets are actually quite strong still, but analysts will give them a bum rap, and there's a bit of a herd mentality in the market, and share prices are not always the best indicator of an asset's value. And we see some extraordinary sort of psychological groupthink around how assets like media are valued. And something, you know, the digital bubble was the best example of that, when things got valued at the most extraordinary rates and were not really anything more than smoke and mirrors. So, you know, sometimes it concerns me that perfectly good businesses that are still doing a great job for their clients and readers and users have become on the nose.
What I would love to see in the next couple of years is there's no doubt through the media reform changes that there's going to be further consolidation from a media owner perspective. And if you take out, great, all of the post-tax synergies and obviously the ability to invest behind technology, where for me I'd love to see it going is that there is going to be a responsibility, certainly on that side, where if a radio station and an outdoor and TV all come together, is that they actually, the investment is behind being able to understand and have a very connected customer through all of those platforms, which I think again will help fuel our industry, fuel brands, rather than it just be a world of consolidation from an investment perspective. It's just about locking a load of media together, and that becomes easier to trade. We're not just going to start shoving more money or change the investment flow just because there's been consolidation around a media owner platform. We're going to put more money in because we're actually getting a much fuller, richer, connected return on investment across all of those individual platforms, and we know whether we're building brand preference, we're actually developing a sale or acquisition. So for me, that's got to be a systemic shift in the media reform changes as well, rather than just the media coming together.
I think there's certainly an expectation that there will be consolidation, but at least probably in the medium term, because there's a recognition that obviously as audiences fragment, there's a need for media owners to stay relevant. But having said that, there's also, I think, a heavy dose of skepticism in the investor community as to the extent of the benefits that consolidation will actually bring. The current media laws have never actually limited media owners from buying what we perceive to be structurally favourable assets, being online or outdoor. If we were to abolish them, you're essentially allowing arguably structurally challenged businesses to buy other structurally challenged assets. And there will be cost out and revenue synergies to be had for sure, but does this solve the longer term problem around audiences and your top line pressures? Probably not.
I think that the incentives are reasonably low, and particularly if we think about the more likely one to be abolished, the 75% reach rule, for a number of the metro TV networks buying the regional stations, they're already getting affiliate fees. It's why buy the cow if you're getting the milk for free? Or the cow's paying you to milk it.